Greetings, everybody. It's Jeff Scott. It is July 3rd, 2016. Happy 4th of July to everybody. Let's go ahead and start this week's review. It's been a number of weeks since I've done this, probably close to a month. This has been a busy, June's always a busy month for me as I go through the big cancer meetings called ASCO. And this week I took almost a 3-week vacation with my lovely wife, went to Europe and Israel, took a cruise in between. I fear it was a good time to be in Europe. All they talked about was Brexit, but no different here, of course. I titled today Brexit from Breakdown to Breakout. Of course, there's a question mark with the breakout. I'll try to make the case for and against whether we're going to higher highs here as we get deeper into the summer. Is it time for a summer rally, or was last week sort of just a reversion back to the mean after a hard sell-off on a week ago, Friday and Monday? Disclaimer, as always, for education purposes only. Any recommendations are in the spirit of education and not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I'm not affiliated with any software vendor or trading company. Tools I demonstrate are those that I use in my daily trading, and I've paid for all the tools that I demonstrate. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. I always like to start with my influences. Again, it's only been a few months since we lost the master Ian Woodward, who passed away, I think, at the age of 85 or 86. What a great guy. Learned so much from him. Ian was a disciple of O'Neill in that Ian learned most of his trading philosophy from listening to O'Neill's radio show in L.A. and then took it further with co-developing the technology and at least the investment technology within HGSI software. Ron Brown, Ian's partner, Morales and Katcher, there's a couple of their books. They used to be money managers for O'Neill, and I think they've taken it to a further degree. My buddy George Lee, great trader from Canada who I've shared the podium with many times, Van Tharp, position sizing, money management guru. And then someone who I spend most of my time with today, these days trading, which is John Person. I just spent a week with him on the cruise for his trading cruise. Those are a couple of his books. I'll talk a lot about John as we go on. The difference and the similarities between Cancelim and John is they both are similar from the perspective that they look at the market, the industry group, and what stocks are working now. Both use a lot of comparative relative strength. Those look at which, both philosophies, I think, include some element of seasonality of what's working now over traditional timing. John has some great indicators for when to make the trade, how to manage the trade, how to scan for the great trades, and we'll talk about some of those as we go on. I have lots of technology. I use pretty much TradeStation and or Thinkorswim for most of my trading. I use HGSI for my post-market analysis as well as EdgeRater. EdgeRater, to me, is just a great tool of automating certain of my market timing processes. You'll see some of them tonight. I like seasonality. I use all the different programs and a number of websites. For those that are new to me or new to HGSI, this is the website for highgrowthstock.com. Most important, if you're interested in the software, it comes with a free 30-day trial. Under investing strategies, look for, my name will have a lot of my old videos, but also Ian Woodward and Ron Brown have a blog as well with a lot of training videos. If by any chance you are new to HGSI and you do download it, I do have some training that I made. It's getting dated, but I think it still is very useful in helping you learn how the different buttons work and how to get up and running. If you do, just email me at hgsidoc@gmail.com. I'm not that I need to plug John's work because he does such a great job on his own. But John is having a 3-day seminar September 24th, 25th, and 26th in South Florida. As you can see, it's about $1,500 all in. I'm not sure if there's any remaining specials, but you can always reach out to Mary. The phone number for the office, I believe, is this 561-655-1881. You can always just go to personsplanet.com. I have added a 1-day pre-meeting on September 23rd in Palm Beach Gardens. I've got about 5 people have paid up now. Not sure if I'm going to go beyond 10, because if I go beyond 10, I will need to move to a different venue. If you are interested, please, it's time. It's $400 unless you're coming to John's program when it's only $300 for the day. Email me at hgsidoc@gmail.com. And if you email me, I could tell you how to pay, and your reservation is not complete until payment is received and acknowledged. So those of you that indicated interest in attending my meeting, you need to contact me again so I can give you the link to pay. And if you're not certain about John's meeting and you pay $400, I will rebate the $100 at the time of the meeting. Stock patterns are cyclical. How quickly things change. We really fell off the boat, so to speak, on Friday morning a week ago as the Brexit vote surprised. You know, the more I think about it, it really wasn't the Brexit itself. Because if you think about it, the Brexit's not going to happen for a couple of years. There'll be a lot of ups and downs until we get there. Markets don't like to be surprised. And when you have a market where everybody's betting that the Brexit's going to fail and then the Brexit doesn't fail, that's why the market sold off. And where are we today? Are we about to go on to higher highs? I'm going to show you some charts that look just like this. Then I'm going to show you a chart that reminds us that we've been stuck in this period here of uncertainty for some time. It matters where we are because I think how you trade really should reflect where we are in the cycle. We are late in a bull, or are we in a bull anymore? Did the corrections of August, September of last year and earlier this year in February, March, did they stop the bull, and are we in a new bull? I don't know what the answer is, but I do know that it was a good time to make money on the long side from Tuesday through Friday, and we've got some momentum going into this week. Speaking about last week, this is how we ended on Friday. So I always like to look at this. I look at this chart during the day. It's a very simple chart. It has sector ETFs, and then John Person actually put this together as part of his indicator set, and I stripped off the indicators because I could look at it on one sheet. And it's got home building stocks, it's got materials, energy, oil, gas, financials, banks, insurers, credit cards, industrials, and so on and so forth. And you could do it simple. You could just get a list of what's in the various major spiders and just create a list of that. Why is it important? Well, I could look at this, and I'm a big believer in things move as a group or as a sector, and I could see that on Friday the financials, almost all of them were down. Regional banks were down. Insurers were down. Broker-dealers were down. So that's interesting. Well, I think I know why. It's because interest rates were so low. As I look around, biotech and healthcare, which had been weak, there was a lot of positive in healthcare this past week. Gold has remained strong. Home builders with low interest rates probably going to do well. Staples have been strong, but this week, at least on Friday, staples and utilities, which have also been leaders, weakened. So is that market rotation? Is it just one day? I find it useful to be able to look at this on a daily basis and sense what's going on in the market. Major markets tell the story. Upper left is the E-minis, the upper middle is the NQs, then come the YMs, the Dow futures, the TFs, which are the Russell futures, then the VIX, and the US dollar. What do you see on the daily charts is you see this big sell-off on everybody and reversal going up on the dollar and on the VIX on Friday and Monday, followed by a snapback rally of 4 days, retaking the major moving averages pretty much across the board on the four long indexes. So are we just one more time going to trot back up here and fail? Will this time be different? Time will tell. Notice we've got daily PPS buy signals across the board. The VIX has come down hard, and the dollar failed at the 200-day moving average. On the weekly charts, same instruments. You could see big weekly moves as well, retaking the 50-day moving average across the board, and you see the VIX fell hard on the week, and the Dow failed at its moving the dollar failed at its moving averages. And if I take this one step further and I look at E-minis, NQs, TFs, the NYSE, and the YM, so the same things but adding NYSE, and looking at daily, weekly, and monthly, what do I see? I see that we have big moves up this week across the board, and we're in daily buy signals on each index. I look at the weeklies and I see that we're back up to where we seem to roll over from time to time. So will we fail once again? We've got a lot of new buy signals came in this week. I think everybody but the NQs had weekly buy signals. And then monthly, you could see the long run up and now the struggling to get above on the monthly highs as well. I think the big news this week were rates got clobbered. If you think about rates, when rates fall, they're great for REITs, MLPs, utilities, dividend payers, home builders, and bonds. Rising rates are good for banks and insurers, so that's why banks and insurers were weak. Here is the 10-year Treasury yield. Here is the 30. For all the next slides, the yellow denotes the indicator I'm looking at, and the white represents the S&P 500. So notice this is about 10 years of time. You probably can't see that well. Yeah, it's 10 years. And you notice that we've now hit about a 10-year low on both the 10 and approaching a 10-year low on the 30. So a couple of different things. This is typically where rates bounce. When rates are low or this low, it's usually a sign of fear. It's a sign of flight to quality, to bonds. It's a concern about the economy. Even during the times of quantitative easing, we didn't necessarily see rates this low. In fact, I sort of written here between 2.5% and 3% on the 10 years was kind of my happy range. And we are well below that happy range. So rates are low, tumbling on the news of Brexit and the increased risk, I believe, to the world economy. This is interesting. Yellow being the Russell 2000 AD line on the left, being the Russell 1000 on the right. The white line's the S&P. And this is actually looks like the small stocks are actually leading the larger stocks higher, but both are reaching towards their multi-year highs. That might be good for the market. Interesting on the NASDAQ AD line, and this is, I think, fascinating. That you can see this yellow line here, the NASDAQ 100 is approaching all-time highs, or at least multi-year highs on the AD line, yet the NASDAQ itself is the worst-looking AD line of the bunch. So big stocks are doing well, but I guess some of these smaller cap NASDAQ stocks, especially those that are too small, perhaps for the Russell 2000, are struggling still. If you look at number of stocks above the 200-day and 40-day SMA, both rebounded to the middle of their patterns with the strength in the market. This helps me at extremes. We're not at extremes. Here's an extreme, 3-month new high, new lows back towards its old highs. So although we're not at old highs in the market, we have a lot of evidence the NASDAQ 100, the AD lines on the Russell 1000 and 2000, the 3-month new high, new low. Perhaps we're going to get to a challenge and retest of old highs. Now, this was an interesting week because many of you have watched me for any time know that I look at the buckets as an indicator of the S&P 1500 being oversold. And typically, and I'd started a video last week, but I had some technical difficulties and I just bailed on it. But typically, when I get such a shift to the left or high percentage of stocks below the lower Bollinger Band, that I know within a couple of days the market's going to bounce. And this was on Friday. 78% of the S&P 1500 were below their midline of their Bollinger Bands. 30% were below the lower Bollinger Band. That was sort of my get ready. Not ready to jump into the longs. But as I ran my scans later on Monday afternoon and saw that 86% of the stocks were below the midline of the S&P 1500 and nearly 60% were below the lower band, I actually put a post together and never sent it to the HGSI board. I don't know why I didn't send it, but I said, time to start going long, and I did. I started, I bought a number of, I closed my shorts, and I started buying some ETFs to the long side, some of the 2X and 3X. And you could see 4 days later, we now have got 14% of the stocks are above the upper Bollinger Band, and only probably a couple percent are below the lower band, as we had a very big bounce from an extreme. These things help me on extremes. When we're not in extremes, they're interesting, but they don't mean a lot to me. How much was this an extreme? On Monday, we hit the 11th highest number of stocks trading below the lower band, when we had 59% were trading below the lower band of the S&P 1500 Bollinger Bands. So when I have the 11th worst time in 20 years, that gives me a sense of how bad this market was and how likely the market was to bounce. If you think back to that day in August when the market really oversold and then we had a nice recovery, August 24th and 25th were number 6 and number 7. So actually, since it starts at 2, it was the 10th worst in the last 20 years. So I knew that we were to a point where a bounce was imminent. Now, I've followed for years the Hindenburg, which I learned from Ian Woodward. The problem with the Hindi, in my mind, one, I'm not sure works anymore, but why would something that worked for decades not work anymore? All NYSE includes a lot of funny things. It includes, well, it's got a lot of energy stocks, energy's had its own little world right now, but it also has a lot of bond funds and interest and preferred instruments. So I'm not sure that the total NYSE is meaningful. I know that Lowry and Associates, they came up with an operating NYSE where they only look at operating companies in the NYSE for their calculations of some of their data. Well, why do I bring that up? Because if I go back the entire year, I don't think we've had a Hindenburg fire or even get close on the all NYSE. So I've started to play around. I've looked at the NASDAQ. Right now I'm looking at the Russell 3000, which is about the same number of stocks that you find in the NYSE. They're operating companies. And I've been looking at that as a group. And it's interesting, in May we did fire off a couple of Hindis, and we actually got close at the end of June. But right now there's not a lot of stocks making new lows, and so there's no Hindi on the horizon. Last week when I was looking at doing my presentation, I was going to talk about this big shot across by the bears here where we had kahunas to the downside across the board. But it's interesting how quickly we had kahunas to the upside on multiple days, and we've now gone green. So it looks like the bulls are back in town or we're back in chop. Canaries in the coal mine. If this was a stock, is this something that you might think is about to break out? You've broken above its moving averages. You're right below the 50. You're in a MOBO breakout. You had some kahunas come in. The Canaries, to me, look like they're poised to break out. They've got to break above the 50. Why is this important? Because if you look at who the Canaries are, a breakout in the Canaries might be considered a big bullish event, and maybe these big stocks will take us higher. If you look at FANG, sort of by Kramer form, it's interesting. Kramer was talking about FANG at the end of the week. I believe from a positive perspective, and maybe you can see why, as the FANG has broke above their 50-day moving average and looks poised to go higher. So one of the tools in EdgeRater is called the Warehouse View, and I wonder if I'm the only person that uses it. But the Warehouse View allows you to take fundamentals or technicals from a date in the past and then look at going forward from that date and make some assessments about the market. So as a top-down investor and a CanSlimmer and HGSI, or things like EPS rank, relative strength rank, group rank matter to me. ERG is the combination of all three. Accumulation, distribution matter to me, and something we talk about at the meetings, the boxes, sometimes matter to me. So one would think in a typical market that stocks with higher EPS rank, relative strength rank, will probably outperform over time. So if we go on the right and we look at a fundamental data, so all these numbers that I use for ERG, etc., were taken on January 1st of 2016. And we look at performance to date from January 1st, we see a curve that's the opposite of what we typically see. And we find stocks with the lowest ERG, the worst EPS, the worst relative strength rank, actually way outperforming. So that is clearly a junk off the bottom rally. If you think about steel, gold, silver, oil, energy, that's where coal, the money has moved this year. So you've had stocks that were horribly beaten up. Look at Techminco, probably the best call that, if those have paid attention to it in February, that I'll ever make. You've had a 500% return if you took my call. No one said they did, so I guess I'm the only one that's happy on that one. But it's that junk off the bottom that's performed. So that's important, because if you're a can slimmer, how are you going to win in a market where EPS rank and relative strength rank are not predictive of performance? Now, the other thing about since the end of the year, those stocks that were in distribution at the end of 2015 have been the highest performers. So that's really wacko for a can slimmer and HGSI person. Now, the last week since the Brexit lows, just looking from Tuesday, Wednesday, Thursday, and Friday, except for the fact that look at these returns, anywhere from 4% up to 8%. This is the curve you expect to see with high ERG stocks outperforming. So is relative strength and EPS rank going to come back into vogue? Time will tell. But we've really been in a junk off the bottom rally for most of this year. You need to know your EPS dates and your news. Not a lot of earnings this week. Greenbrier, there's a couple there that are probably big ones for you or me. I've got one in there. But you need to know where they are, and that's my statement below. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. I use Leave It Brothers often just to get a list. I have other sources, but this is a free one on the web. And then these are the economic releases. I don't think anything's going to budge rates in July or probably August or September, but we do have some big things. The non-farm payrolls come out on Friday. John Person calls this the monthly unenjoyment report. If the Fed was on the edge of their seat to raise rates, that might be more meaningful. Now, that said, and just to go back to this picture here, I wonder if the Fed's happy with rates this low. So, the rest of the world's going to negative rates. Even Janet, Jumpin' Janet as they call her in some places, has mentioned negative rates as a possibility. I would not be surprised that if we get positive economic numbers, for the Fed to start talking up interest rates again. Not to do anything, but as we saw going into June, they had talked, they'd said the market was discounting a rate hike, ... I think the Fed may use their mouth to get these rates to move up, even though from a pen and a policy perspective, they probably can't. A couple of my thoughts about the market. Certainly market brushed off Brexit, moves back towards resistance. Interest rates are approaching multi-year lows. Strength seen in dividend payers, bonds, REITs, utilities, and dividend-paying stocks. Junk off bottom has been the theme of 2016, led by energy and metals, continued post-Brexit. Brazil showed pre-Olympic strength. And do the 80 lines predict new highs before year end? Now, I wanted to stop here and put this slide up because I think this is a very interesting slide. This is the market from 05 running up to 07, really having a double top, breaking through. I think this box originally came over here, but breaking out of the box, the 2008 lows, and then starting in March of 2009, when we started to believe that this rally was real, a massive rally. And then since middle of 2015, I've got two red lines. The first was the old high, and then the second red line is sort of the high that we've been bumping up against. And the green lines show you that we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, at least 9 attempts to break higher. So if you're bullish, you really want to see us take out those red lines. If you're bearish, it's easy to say, with this many attempts at this resistance, each time it fails, it gets tougher and tougher. So we are in a place where you'd expect it to be a little bit of work for this market to get higher. So the agenda, after my introductory comments, market review, top-down analysis, bottoms-up work, and then the charts of the week. So I'm going to stop the tape for a second and resume in a minute. All right, I'm back. I'll close this down. Let's go take a look at the markets. That's done. I always like to go into TradeStation, and I go into this view here. And I know it probably confuses people because I start to bring in other indicators. But I like to look at the futures or the major indexes, and I really look at 3 to 5 different things here. The first thing I look at is the color of the paint bar. And this is actually from Alexander Elder. It's called the impulse indicator. He uses the color of this as a filter, as I've understood him and I've listened to him teach, and that if it's green, it's okay for him to go long or to hold, but he shouldn't short. If the paint bar is red, it's okay for him to go short or hold, but he shouldn't initiate new longs. And if it's blue, it's neutral, and he can go long or short or hold. Second thing I'm looking at is the relationship of price bars to its envelope. And this is his auto envelope. And, you know, one thing you'll notice is sometimes the indexes just track along the top or bottom of the envelope for a long time. So that's not really what I'm looking for. I'm looking for things like what we saw on Monday night of a move way below the envelope. Because whenever I see a move way below or way above the envelope is more evidence that I'm going to see a snapback of the index, up or down, depending on where it's at. The third thing I looked at, maybe the most important, are the green and red arrows, which are John's buy and sell signals. The fourth thing I'm looking for are, see these green dots here? If there are green dots at the bottom of a price bar, then that's suggesting that you have some MACD convergence or bullish divergence on the MACD. If there are red dots on top, it's a bearish MACD divergence. And then the other thing I look at is the high jump bar, just to get a sense of whether I'm overly extended. So utilities have been at an all-time high. So you could see utilities are at 98%. Now, what does that 98% tell me? 98% tells me that over the last 200 bars, so on a daily chart, that would be for the last year, that's the highest extension that the utilities have had, or it's 98% of the highest extension. And I measure extension by something I learned from Ian. I mean, what a master. The difference between the price in the 17 bar plus the price in the 50 and the price in the 200. Why is that important? Because typically when you get to levels like this, you pull back. And you pull back. So this is telling me that this is a high risk area. So those are the 5 things we're going to look at on each index. Let's start with the S&P 500 or the E-minis. We are in a daily buy, a monthly buy, but a weekly sell. So we were in the setting of a pullback on the E-minis according to John's indicators. We got a red, we got a green weekly, so that tells me from the Elder perspective everything is green, so that's improving. I don't see any divergences. I'm at 87%, which is not at the top. I think this is very bullish, and this will probably flip this week, I suspect. And we know that on the other platform, I'm looking at it right now, which there's a little bit differences between them. You did flip the person indicator on Friday on the weekly. On the NASDAQ, similar pattern, except it's just blue on the, there's a green on the monthly. I'll take that back. So it's in a buy on the daily and monthly. Did pull back on the weekly, but it's now got a green paint bar. And on Genesis, it's already flipped to a buy signal there as well at 63%. The Russell, So the Russell, you could see it had the bearish divergence leading to a pullback, drop below the envelope, had a buy signal come in. We got a buy signal on the daily and the monthly, green across, no divergences at 82%. And then the YMs, which would be the Dow futures, I feel like a broken record. It's the same pattern. So I look at the futures and I see markets that are pretty much in buy signals throughout. That weekly person will flip probably on all of these this week if the market trades any higher. I might want to look at sectors the same way. So materials. Again, materials gave us a nice signal here. It's only blue on the daily and the weekly, so it's not as strong. It's in a sell on the weekly, but it did get a new person buy on the daily. It's still in a longer term buy. So materials got beaten up, but they're starting to move higher. I believe the metals are in materials. Energy has been a leader of late, and it's green across, buy signals across. It's been in a buy signal almost all of this year on the weekly as well. So energy looks strong. Finances, you'd expect them to be weak, and you could see not only are they having a weekly sell, they're red, but interestingly, they went green in a buy signal on Thursday with the market rally. Didn't do much on Friday. And again, they dropped below their envelope. It's this drop below the envelope which gets me excited because I know the market's going to reverse. The industrials, green, green, and green, buy signals daily and week monthly. Looks like the indexes. Technology, green, green, and green, buy, sell, buy. Again, looks just like the indexes. Staples have been leaders. And notice what happened here. Staples are above the envelope, so that's a little bit concerning, but it hasn't had a move yet. I'm not going to bail just because it's above the envelope. I'm going to recognize that staples are getting extended. They're at 92% here. You notice the MACD divergence dots, again, another sign of extension. Obviously, green, 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 buy, buy, buy. Staples extremely strong. They look overheated. I might be looking for a place for a pullback, might be in staples, but things often have a tendency that are strong to stay strong. But it's outside the envelope on the weekly as well. Utilities, again, like staples, here's the MACD divergence. You can't see it up here. There's one as well on the daily and on the weekly. Strong like staples, looks extended at 98%. We already looked at that. Healthcare has been one of the laggards. Did reverse this week, although you still got a weekly sell signal on John. And then discretionary, not clearly as extended as staples, in a buy, greens across. So this is a pretty strong market. I mean, staples and utilities look like they've had their run. Things in motion continue to stay in motion longer than one might expect. But I think they bear watching. All right, let's go into HGSI. First thing we're going to do is go into Major Markets Plus. This is my top-down view. And the top-down view takes 23 different indexes, looks at price and volume, 1 day greater than 5 day, greater than 3 weeks as far as influence. And it gives me a great idea of where the money is moving in this market. So gold, silver, oil, bonds, no surprise. Biotech, that's a bit of a surprise. Dollar and volatility weak, semiconductors weak, some of the big stocks weak. So let's take a look and see what we see, or weak comparatively. Because if you look at 5 day performance, all the stocks were up. Volatility was down 42%. Wow, gas down 0.9 and the dollar down 0.1. So let's take a look at the S&P 500. So first thing I want to show you, and then I'll get off of it, is we did have bongos or kahunas this week on several days on the major indexes. Everybody had a kahuna, I believe, on Wednesday and Thursday, and I don't think there were kahunas on Friday. So the kahunas are momentum indicators showing strength, and all the major indexes have them. The other thing to look at are these green bars. These are called eurekas, and the dark eureka is more meaningful than the light eureka. And these are sort of follow-through days on the market. Now, you notice we had a couple of red ones early on Thursday and Monday. And when we see those, especially the second one, it makes you think that the market has been overdone and too much exuberance to the downside. And these are sort of the HGSI version of the follow-through day, and we had two follow-through days to the upside. So is the market confused here? Absolutely. I think this is the definition of chop, where we had 5 days in a row with Eurekas. 3 to the upside, so I'm going to give a little bit of a vote to the upside. But those Eurekas, again, another reason to be interested on the long side, I believe. Now, the other thing I want to flip to, let me just go to my simple view here, is these two are Hindenburgs, and there was a Hindenburg using one of the techniques we follow, which is interesting, that occurred on Friday. Now, I'm not going to believe it because we've had, let me make sure that's even what I'm thinking it is. Yeah, I don't know what to do with that, but I'm going to at least pay attention to that. We changed how the Hindenburgs are measured. I mentioned that we have issues with the NYSE, but what I wanted to show you was the weekly bongo on top turned green, and that weekly bongo is my sell signal and buy signal. And the fact that my weekly bongo's gone green is very meaningful. So if we tighten this up or give you some more data, uptrend, sideways, I showed you how many times we've hit our head on it. But big move up this week. We've got resistance to get through. That's going to be the challenge, and we're getting up to there. One of these days we're likely to pop. We'll see if this is the time. The Dow Jones Industrials looks a lot like the S&P. Bongos are green. The NASDAQ. Bongos are green, breaking above its major moving averages here. I'm sorry, that looks bullish to me. If I had to pick bullish or bearish, I'm bullish on these things. Although I don't forget the fact that we are right up, especially on the big stocks, against resistance. And then the Russell 2000, again, getting close to resistance, but a big bullish move above the moving averages. So the major indexes look strong. The dollar failed at the 200-day moving average, came back down. That was very bullish for the market, I believe, because the strong dollar would be a tailwind, especially, or headwind rather, on metals and energy, which have been some of the leaders of this market. Notice its bongos remain green. The VIX got clobbered this week, but that's what the VIX does. When the VIX is low, look out below. When it's high, it's time to buy. Well, we had a high VIX on Friday, and then Monday it sold off. The interesting thing was on Monday, 1, 2, 3, 4, it was selling off despite the market going down. That was a pretty good signal that this market was going to bounce. And you could see the VIX has a weekly bongos gone red, so the VIX is in a sell, which is good for the market. And then if the dollar's weak, we know gold is strong. Now, I'm looking at, as Brexit fears, if they start to lessen, you might see gold and silver give up some of their luster. But boy, if you were smart enough to be in JNUG or what's the junior one? Or Nugget, that is the junior one. You've been making a lot of money with the 3X ETFs. And silver doing well. Now, I just want to look at gold because I was not the most bullish on gold months ago, but I changed, and I want to show you where I changed and why I changed. You notice back here, I changed with this arrow mark. The nice thing about this program is unless I erase things, and I changed because we broke through a descending trend line. We broke through the 200-day moving average. We broke through the 17 and the 50 and then the 200. And then we retested. And My sense on gold changed earlier this year at this point. And, you know, God bless the people that, again, who are in the 3X directions because they're making a fortune. I'm in a number of gold stocks, but I didn't go with the 3Xs. And this is the 1,000-day moving average. It's even broke above its 1,000-day. Gotta like gold right now. Liked it even better when it broke out here with the arrow, which would have been closer to 110 or 1,100. So I wasn't a gold bug last year, and I became more of a gold bug, I think. Those numbers show you back in February. All right, so markets are strong. Were strong last week. Let's look at the forced 2-day up, and let's go to major industry groups. And you could see that I've got 90 industry groups with a positive 2-day force. That tells you how much strength we had at the end of the week. With the 2-day force to the downside, nobody. 5-day force to the downside. Banks, brokers, wealth management, investment management, life insurance, casinos, semiconductors. So many of those are financial. 5 days to the upside doesn't mean a whole lot right now. It's 81 because the key here is that you've got 90 of my 170 groups showing major momentum to the upside. Now let's look at what's there. In top-down investor, I usually look at the first 10 or so: metals, oil, gas, metals, metals. 5 of the top 10 are these junk off the bottom stocks that have had huge moves. Look at these 5-day moves. Precious metals up 11%. Steel and raw materials up 10.5%. Biotech, auto, specialty pharma, packaged foods. And if we drop down with integrated oil, steel producers, banks being up here is interesting. It might be some of the foreign banks moving up as things quieted down. And then airlines and large pharma. So 2-day force, interesting stuff moving to the top. Then I like to right-click, change index group, and just get a sense of what's the strongest in the various groups. Now I'm going to hook into my busy view, and my busy view has everything I use on it except for John's indicators. So let me spend a few seconds telling you what I'm doing here. At the top, these 2 green here are the weekly bongos. My weekly bongo on American Barracks went positive back here in October at about $8. It has stayed positive since then. That is my main market and one of the things I always filter buy-sell signals on. This here with the going yellow and green, that's my accumulation distribution. Then I have my force. I have my high jump. That's a red candle low. That's a green candle high. Then on the next series of bars, I've got 3 indicators. I have Bible gap ups, which is nothing, a squeeze, and then MOBO. Down here, I'm going to close this one because it's more experimental. I have my pocket pivots, up and down, the darker, the bigger. I've got my Eurekas, which are only calculated on the NYSE. And then I got my volume, and on my volume I have the kahunas. And here I've got my on-balance volume with its moving average. So let's go back to let's just go back and look at American Barracks. So everything is green, breaking out to new highs, or at least recent highs. Strong market. Earnings are out July 27th. You got to love American Barracks until it stops going up. And I call it Barrel. Newmont looks the same, very strong. Silver wheat and the steel stock looks like it's starting another run. Notice that very extended at the top of its high jump bar. So if I went back here into TradeStation, I'm just curious. Let me just put it in SLW. It's at 100%. It's as high as extended as it's been in the last 200 days. And I'm guessing it's back around here and here and here. And you could see that it's getting at a place where you'd expect the market to pull back. Rand Gold, So gold and silver are strong. Oil gas services, the drillers are what's popped up here, even before I get to the big boys. So this is sort of the story of 2016. Here's a stock that, let's make this smaller. Actually, let's go to a monthly. Here's a stock that peaked at 160 plus in 2008, has been down in the single digits, and now it's stirring. Pays a 1.2% dividend, broke above the 200-day moving average. Everything is green here. Had a kahuna on Friday. Rig looks strong. Look at the PE, 2.93. ENSCO used to have a huge dividend. It's now down to almost nothing. Makes money, but no growth. Sitting on the 50, had a kahuna, mobile breakout from a squeeze. Everything looks good up top. Noble Energy. So you're buying bottom fishers here. Halliburton, nice breakout, move up despite its sale or purchase of Baker Hughes being blocked. I don't have any Halliburton, but I've got a pretty big position in Schlumberger. Atwood I find interesting, and it's on my buy list for Monday. Mobile breakout from a squeeze. Everything is green. This could have been my stock pick of the week. 2.3% dividend, lots of demand, money coming in, kahuna. Gotta like that picture. And here's Schlumberger. It has not had the move up of Halliburton, but this is one of the leaders when it comes to oil services. I like Atwood there. Exploration and production. I have several of these. I'm sure you do as well. You look at something like Marathon Oil. Its bongo went positive as it broke through the 50 here. By the way, there's absolutely nothing to do between the 50-day moving average and the bongo. It's interesting how often that when the weekly bongo goes, it's the stock crossing over the 50. I have my ideas of why, but I just find that interesting. Group has moved up. Here's a stock that's been in a slow move up over the last, since the beginning of the year, it's up 24%. Looks like it's breaking out here. Everything is green. Anadarko Petroleum looks like it may want to go as well with a big kahuna. I mean, I own some Devon. I own some Marathon. I own some Range Resources. I own some Apache. I basically did bottom fishing at the beginning of the year, and I bought stocks that had been great companies in the past. And, what I do with these is, and maybe it's not the smartest, is I buy options. And I just keep rolling the options up and out. I keep taking them off the table. Sometimes I just exercise the options eventually. But I found options a way to play some of these bounces off the bottom. Base metals. All right. I have to go back and find this because if I remember correctly, it was about this bar here. When I started talking about this company, one of the times I talked about it, actually I think it was back here, breaking above the 50 and the bongo turning green. And I let you know about this company called Techminco, which I bought in March of 2009. It ran up to 40. I called it my lottery pick of the month, of the year. It was at $4. It's now at $14.75 or so. And it's breaking out and it's going to go higher. Here's a base metal stock. It's been losing money. I like to think it's stabilizing and maybe it's going to go out, eventually go back up. This is my target, is the 200-day moving average. I took a huge position when I mentioned it to you, and it's been a very nice return. On a $4 stock, I didn't buy the options. I bought the stock. I wish I would have bought a lot more. I still bought a lot of shares. Freeport-McMoRan had its nice little move, sort of going sideways. They got some issues about some energy assets, which maybe now it's good they didn't divest them. They've got some gold. They got some copper. Sideways here. We'll see if this one can participate this week as well. Alcoa splitting into a couple different companies. Steel raw materials. I actually took my profits on this, which was probably a mistake. Valley is a Brazil stock. There was a lot of action on Brazil at the end of the week. I don't know if this is Olympic related. Maybe it's just the market quieting down. Valley is an iron ore stock. TCK has iron ore as well. Rio Tinto ranking above the 200-day moving average. Look at when the bongos went red on the weekly bongo here. Breaking above the 50, back down around $28. I can't buy any more of these stocks. I've got a bunch of them like I do on the energy, and every time the dollar gets strength, I get pummeled. But I've had to hold on. But again, I keep rolling my options out on them, up and out, so that I try and keep my actual money in the market small and participate in the upside by taking my profits out on a regular basis. Talk about that at our live meeting. The next group to look at, REITs, big. Here's Weyerhaeuser, 4.1% dividend, kind of choppy. Now, hotel stocks have been in a downtrend. I noticed last week they were starting to recover. Here's Host Marriott, 4.9%. It's got growth coming in. Look at the group strength there. Simon Property Group. The one that I've been long a couple of these. And the one that I turned you guys on to several months ago was Cone, or Cyrus One, which basically on Thursday hit an all-time high. Look at the earnings per share growth, pays a 2.8% dividend. Of course, it's extended, which is why it had a tough day on Friday. And this is where that high jump bar comes in handy. 91%. Okay, can still go. This was after it pulled back some on Friday. Biotech, been a laggard. A lot of the move is related to Tesaro, which had some positive news. This is the good side of biotech. You get surprises to the upside when the news is big. Gilead, great drugs, struggles. You know, you look at the last 5 days, it's in a new bull run. I'm kidding, but is this the beginning of something? These stocks have been hammered. Biogen, Amgen, all of these are below their major moving averages. But they all, like Anilin did here, had some nice moves up this week. This one was interesting. It had a big move up, stalled at the 50. Notice everything turned green there, and it had a kahuna. Automobiles, probably driven by Harley Davidson, who's got a potential acquisition discussion going on. Hard to play these after this move, unless you really know something about the industry and you could put a valuation of what they're likely to go for. Tesla, been all over the place. It dropped when it said it was going to buy Solar City. Then after hours on Thursday, it dropped when they had a death in an autopiloted car. And then despite that, it had a pretty good close on Friday. I look at this as more of a stock to think about shorting if the market rolls over as it's going into a confluence of its moving averages here. I've been burned when I tried to short this one before, especially with the bongo going green on the weekly. But, I mean, if this market rolls over, it's at a great shorting place. So this is what I typically do. I go through the top 10 groups, specialty pharma, endo up because it's going to sell assets. That's not necessarily a reason why I would want to buy a stock. Again, junk off the bottom. Here's an interesting chart. XBIT, XBiotech, starting to get extended. Again, I can't buy something that we're going to look at here and it's going to tell me that it's how far above? Well, that's a 0. If it's an IPO and it doesn't have enough data, it won't give me an answer, and that's the problem here. It must not have enough data. Yeah, you can see the 200-day didn't come in until February. So I don't have enough data to give me a high jump, but boy, this one looks like it's getting extended. It certainly is here. If you want to play biotech, consider LABU. Oh boy, it doesn't look like much, does it? LABU has gotten down to where it's bottomed several times, has moved back up. You can look at BIB, and these are leveraged ETFs that give you the benefit of what biotech does. It eliminates some of the individual news risk, and if you think biotech is going up, that's a way of playing it. Packaged food, how boring, and this is driven because of the now M&A activity around Hershey. Again, I don't know how you play something that's had a move like that. So I usually start by going through the top 10 groups. Other things that I like to do to build my watch list. How long has this been going on for? We're at about 55 minutes. Is I do various scans on the market. So I might go into all groups, all securities. One of my favorite scans is this one here. It requires momentum coming in above the 200-day moving average and within 2% of the 50-day moving average. So these should be stocks that were in uptrends that pulled back that are showing momentum. So Home Depot has been in an uptrend. It's pulled back to the moving averages. It's within 2% of the 50. It had a kahuna in. OBV broke above its moving average. It's still in a weekly downturn. Probably going to take a few more days to get above that 50. I would put that on a watch list. I'm going to find one that looks better if I can. All right, so none really jump out at me. Home Depot looked the best. All right, so then I might do another scan, which are stocks in a squeeze that are about to have a PSAI reversal to the upside. So I'll show you a couple of these. Here's in a downtrend, so I would skip. I want stocks that are in uptrends above their 200-day moving average. All right, HYH. Here's a stock that the weekly bongo turned green back here in March, February, March. It's had a nice little move up from about 28 to 34. Pull back to the 50, which would have been a great time to buy it. Broke above the 17 on Friday. So I could look at this. This could be a get on a plane trade. What do I call it a get on a plane trade? I've got a kahuna, a mobile breakout from a squeeze. Everything is green. I like everything that I see here. It makes money. Medical devices, which have been strong. But, you know, I may or may not be around tomorrow to manage the trade. So what I like to do on a get out of plane trade is I start to play games. So for a get out of plane trade, I need a couple of things. I need to have a reproducible buy signal. So that red dot's a PSAR dot. So I know if the stock trades above that PSAR dot, it's going to set a Wells Wilder system buy signal. So I'm not going to make the trade unless I trade above that dot. And I know that on Friday, that dot closed at 33.85. So I might go 10% above that, and I might put my buy at 33.95. If the market opens lower on Monday, I won't get filled, or Tuesday as the case may be. Then I need to find a place for a stop. What a great place to my stop. I think the 50-day moving average makes sense. So that's at 30.86. So I'm going to set my stop right below the moving average. So say they're at 30.75. I'm risking $3.20, which is a little bit, about 9%, which is a little bit more than I might want to risk. So I could look at putting the stop at the 17, but I'm feeling lucky. I'm going to put my stop here. And so I could get on my plane and say, if the stock trades above my buy, take a long position at my limit price, immediately put a stop limit in at the 50. And now what I've done is I've entered a trade that I want to be in. I've got a well-defined buy point, stop loss. The 9 to 10% is within my risk category, and I go on to the next one. Hyatt, same thing, broke above, bond goes green, right below the PSAR dot. It's in a squeeze, which means all these moving averages have come together, so I could set my stop at about 47, my buy at a little bit above 50. I'm risking about 6% on a stock that's basing, has positive momentum, and a clearly defined buy point. Here's a stock, Netgear. Pull back to the 17, looks like it wants to go again, right below the PSAR dot. I have other scans that I've built in. All these come for free with HGSI, by the way. Strong technicals. So I could look at stocks with strong technicals. U.S. Steel. Well, this broke above its PSAR dot on Friday. Mobile breakout from a squeeze. A kahuna. Group strength is high. Everything is green. Makes money, or is going to start making money soon. Pays a small dividend. U.S. Steel looks interesting. Atwood, we already picked as one that would be a potential buy. Nova Gold. Flowtech, an oil services stock, broke above its PSR on Friday. Mobile breakout from a squeeze. Kahuna, everything is green. So I have a system here where I have a number of scans that I use to find stocks to buy. So what I do over the weekend is I create a lot of different watch lists. So for those of you that are market smithers, can slimmers, etc., I create a number of lists that I take from various places. So some of these are IBD lists. Some of these are Market Smith lists. I then have within the designer, I have a number of scans that are HGSI scans. These are automated scans that are done for me, sprinters, 3x volume, so on and so forth. And then I have some of my own scans I've put together. I combine all the stocks into a watch list called Consolidated Buys. I add to that watch list some of my scans from TradeStation. I'm going to go talk about that in a second. And then this weekend I looked at about 700 stocks. And after I went through my 700 stocks, I came down to my watch list for the week, which was way too long, but a lot longer than, last week I could hardly find any stocks on Monday that looked like I wanted to buy right away. And these were some of the stocks that I picked. And I've picked these stocks for various reasons. And I might look at the industry and I could see I had pharma, REITs, mining, oil, gas services, lots of energy stocks. Probably not a whole lot of consumer staples here. I could add sector to this to look at that if I wanted to. I think I probably got sector back here, don't I? From the sectors, we got discretionary, got a few staples, energy, financials, materials, lots of material stocks. Made my buy list. And then I go through each stock in my buy list, and then I look at them in TradeStation with John's indicators to make my decisions. So let me show you some of the stocks that made my cuts and show you how I use John's indicators. So what I like about John, and I say this a lot, is that he hasn't changed what he does in probably 20 years. He has a small number of indicators. If you go to his education, he teaches you exactly what's in the indicators, except for the PPS. And he shows you how he uses everything to trade. I don't even know what goes into a PPS. If you're a thinker swimmer, you have his PPS for free and his pivots for free. If you're TradeStation in the App Store, you can get his daily pivots for free. But it's the rest of the package that works for me. So let's talk about a couple of his signals. And let's just go here. So last week, I was going to tell you to short Autolive, ALV. So let's go into my LCD weeklies and so this is from last week. So let me click back to last week. And I was looking for stocks to short. So what I have from John are a number of things that are important to me. First thing is, as I mentioned before, his buy signals in green and his sell signals in red. The second thing that we have for John, and you'll learn about at my meeting or his meeting, are what the high close doji and low close dojis are. Some things that he'll teach you called the last conditional changes. And we use these to find stocks to buy and sell and how to manage them. Now, these are a messy slide because it's kind of things that I use. But what I can do during the day in TradeStation is I'm going to look at, we'll just put futures up there. And I could look at the futures, and I could be looking, this is daily, at daily, weekly, and monthly signals. I could look for new buy signals. I can tell me what the trend is going up or down. I can look for high and low close dojis when they occur. And this is probably not the latest version of that. So this one is. I have the high close and low close dojis. This is on stocks. So I can look at stocks. And so during the day, I'm using TradeStation to help me find stocks that might be actionable. At night, I'm running my various scans, and I'm looking for his signals that I find so attractive. So I know that a low close doji is my favorite sell signal. And if I can find a stock that had a low close doji that's in a person sell signal on the weekly and on the daily, and the OBV is broken down, that I find something that's a potential sale. So I found ALV, and that was the stock that I shorted at the beginning on Monday morning. Now, of course, with the market turning around, that wasn't going to be a great trade, yet I made money on the trade even though the market rebounded. So I have high closes, which are bullish, low closes, which are bearish. So these were the scans from this week. And if I look at weekly high close dojis, which is where I like to circle, there's close to 200. So I've toned them down, and let's go into my screener slides. These are the stocks that made my interest list for this coming week. The first stock is Royal Gold, RGLD. Royal Gold we looked at before. The problem with Royal Gold is it's getting extended. OBV is maxed out, which is great. Big uptrend, OBV on weekly and daily. To the right is daily, the middle is weekly, to the left is monthly. SSRI I liked a lot as well. Again, it's extended, which is a bother. Beacon Roofing. If housing picks up, this is a stock that might be expected to go. It was basing, had a high close doji, strong volume. That got me interested on the weekly. It's in a weekly buyback here, a daily buyback here. The thing I was nervous about Beacon Roofing is because it's starting to have evidence of some divergence as it's getting extended. I almost picked this as my trade of week. ILG, which is Interval Leisure Group. Again, strong OBV. HCD on a weekly breakout, in a weekly and a daily buy signal. Like that a lot as well. I'm not going to go into it today, but you notice these dots here, my dots. This tells me that it had a mobile breakout from a squeeze. PSAR is supportive, and you had a Kahuna Force as well on the weekly. Invacare is a healthcare stock. This one is sort of the pattern that I like to trade. So a couple different things here on Invacare. I've got my bongos here, so the daily and weekly are green. That's good. Monthly is red. This yellow dot tells me it's been in a squeeze. It had a PSAR reversal on Friday. It's in a PPS buy on the daily. On the weekly, OBV is moving fast higher in a high close doji in a stock that's been in a downtrend. This is one of my favorite patterns, and tech looked a lot like that TCK when I said to take it. Here's Marathon Oil, also had a high close doji a week ago, breaking out to new highs, high close doji on the daily. Starting to get extended with the divergence dots, good OBV. XNCR, this is a biotech stock, I believe, that had a big move on Friday. Too big of a move, up 5 or 6 points. I had to pass. Interestingly, that BP made my list. It's, is it extended? Here's a monthly on BP. It's hard to say it's extended. It's fallen from the mid-50s. It's now at 36. The reason why BP looked interesting to me was because a high closed doji, super strong OBV, coming out of a squeeze on the weekly. All my bongos are green. Daily and weekly buy signals. BP looked good. APLE is a REIT. Again, the pattern I like to see, weekly squeeze, OBV breaking out to new highs, high closed doji on the weekly, daily into a buy, weekly into a buy, OBV strong on daily. My bongos, at least daily and weekly, are positive. There's no monthly because it's a newer issue. AROC, I think the E is a problem. I don't know if it means they're late on reports, but AROC also a high closed doji, strong OBV. I'm getting tired, so I'm going to pick it up. LNG, here's a stock going sideways with a high closed doji, PPS weekly and daily buy. OBV through the week, coming out of a squeeze, like this one a lot as well. Whole Foods, I didn't pick this one because I lost money on this move up. But yeah, high closed doji, strong OBV in a daily and weekly buy signal. The Gap, sort of a bottom fisher, but look at the OBV breaking out above a downtrend, above the moving average. And the stock's starting to move up on a PPS weekly. If you don't have a retail apparel stock and you want to nibble something that's probably at a discount, fall into the Gap, GPS. We'll come back to this one. AINV is Apollo Investment Group that pays a huge dividend, about 16%. High closed doji, daily weekly PPS is strong OBV. CBD is a Brazilian distributor in the food services and I think stores. High closed doji, strong OBV. UNG, this is a stock that seems to be making a move. Natural gas, strong OBV, another HCD. And now we'll go back to MCC, which is my stock pick of the week. So I know that was fast and probably blew many of you away, but this is some of the reasons why I've liked to combine the best of HGSI with John's work. And that's where the PUG user group comes in. It's something that I formed, which is a bunch of folks who have both John's stuff and HGSI. My classes are free. I'll be doing one in the next couple of weeks. If you have John's Indicators lifetime package, I'd love to have you participate. Just drop me an email. If you're interested in John's stuff, talk to me, and we'll see if I can't help you out. Again, John's got a seminar coming up the 24th, 25th, and 26th. Everything that I do on these programs, I will be reviewing in great detail on the 23rd. If you're interested, please drop me a note. Chart of the week. I present these for educational purposes only. Trading, especially options, carry substantial risk of loss. I do not warrant any expectation of return. I may or may not already have a position. I plan on taking the trades that they execute so I can discuss on the following session. And I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I choose a specific stock or option strategy, and where I plan on taking profits or placing stops. So here is MCC, and this is why I'm bullish. First thing is the stock's been in a horrible downtrend. Look at that 200-day moving average. Now look at how good my weekly bongo was picking up a buy signal back here when it was a couple bucks cheaper or a buck cheaper. Why do I like it now? Everything turned green on my upper bands, my bongos, my force, and my distribution. I recognize that we're near the high jump, but I ignore the high jump because we're sitting on the 200-day bar. The high jump only works on extended things. It doesn't work for things that are below the 200 or been in a downtrend. It's coming out of a mobile breakout from a squeeze. The group strength is high in an uptrend. I broke above the last remaining moving average above the 200-day moving average. I have Eurekas in the market. I had a kahuna. I love this pattern. It pays a 16.7% dividend. Crazy, huh? Love the pattern. Here's what I saw on TradeStation. On TradeStation on the daily, I saw a PPS daily buy signal. On the daily, the OBV broke above its moving average and it's descending downtrend. My bongos daily and weekly are green. It's not old enough to have a monthly. No red on my dots. And we'll skip that one because I don't want to talk about that one today. Big up move. On the weekly, I've got a high close doji on the weekly buy signal, OBV's a nice uptrend, and a stock that's been in a downtrend. We talked about the bongos already. So I've got a lot of reasons to like this. I'm going to put a buy stop at 725, a sell stop at 670. My first target is 780. It's 55 cents, which is about a 7.5% move. I will sell half at my first target and raise my stop to break even and let the rest ride. That is very conservative. I'd rather go to a 2-to-1 return, but the way that this market has been is I take my profits off when I get them. I can buy about 3,600 shares. So if you like what I do, hgsidoc@gmail.com. Reach out to me. Love to see you in Florida. Have a great week. You know, this market obviously can go either way. If I had to bet, I bet it goes higher. But this is my nest egg. This isn't gambling. So I will be tempered in my enthusiasm, and I'll trade the market I get, not the market I think I should have. Have a happy 4th of July, and God bless those that served and helped make this great country what it is today. Thank you. Goodbye.